Have you ever calculated how many hours you've traded for money in your lifetime and felt a little sick to your stomach? You know the drill. You wake up, trade 8 hours of your day for a paycheck, and then repeat the cycle until you're old enough to finally stop. Well, here's a thought that might make you question everything. What if your money could work just as hard as you do? What if instead of being the only one earning in your household, your dollars could clock in and start generating income while you sleep, travel, or binge watch your favorite show? The concept of passive income isn't some get-rich-quick scheme or multi-level marketing pitch. It's the fundamental difference between people who achieve financial freedom and those who remain trapped in the time for money exchange their entire lives. And here's the really exciting part. Once you understand how to make your money work for you, you'll wonder why you spent so many years working so hard for it. My name is Nick, and I've dedicated years to understanding the mechanics of passive income and wealth generation. If you're tired of being the only one working in your financial life, and you want to learn how to build systems that generate income without your constant involvement, make sure to subscribe and hit that like button, because what I'm about to share could fundamentally change how you think about money and time. Now, before we get into the strategies, let me address the elephant in the room. When most people hear passive income, they immediately think it means doing nothing and watching money magically appear in their bank account. That's not how this works. The passive part comes after you've done the initial work to set up the system. Think of it like planting a fruit tree. You have to dig the hole, plant the seed, water it consistently, and nurture it for years before it produces fruit. But once that tree is established, it keeps producing year after year with minimal effort on your part. That's the power of passive income. You put in the work up front and then you reap the rewards indefinitely. The wealthy understand this concept intuitively. They know that trading time for money has a ceiling. There are only so many hours in a day and you can only charge so much for your time. But when you shift your focus to making your money work for you, suddenly there's no limit. Your money doesn't get tired. It doesn't need vacation days. It doesn't call in sick. It just keeps working 24/7, generating returns that compound over time. The question isn't whether you should pursue passive income. The question is why you haven't started already. Let me share something that might change your perspective entirely. The average person spends 40 years working a job, saving a modest amount, and hoping they have enough to retire. Meanwhile, someone who understands passive income might work intensely for 10 to 15 years building income-generating assets, then spend the rest of their life doing whatever they want while their money continues to flow in. Same amount of total work, completely different outcome. It's not about working harder. It's about working smarter and understanding how to leverage your resources. Throughout this video, I'm going to walk you through the key concepts and strategies for creating passive income streams that can eventually replace your active income entirely. We're going to cover everything from the mindset shifts you need to make to the specific investment vehicles that can generate consistent cash flow. And yes, I'm going to show you exactly when and how your money begins working for you in meaningful ways. But first, let's talk about why most people never escape the active income trap. It's not because they're lazy or unmotivated. It's because they've been conditioned to believe that earning money requires constant effort. From the time we're children, we're taught that you have to work hard to make money, get good grades, get a good job, work your way up the ladder. Nobody teaches us about leverage. Nobody explains that the real game is building assets that generate income whether you're actively working or not. This conditioning runs deep. People feel guilty about the idea of earning money without actively working for it. They think it's somehow cheating or that they don't deserve income they haven't directly labored for. But here's what they're missing. When you invest your money, you're putting it to work. You're taking capital that you earned through your labor and deploying it in ways that create value for others. That's not cheating. That's how the entire economic system is designed to function. The shift from active income to passive income requires a fundamental change in how you view money. Instead of seeing dollars as something you exchange for goods and services, you need to start seeing them as employees. Each dollar you save and invest is like hiring a worker who will generate returns for you indefinitely. The more workers you hire, the more income they generate collectively. Eventually, your army of dollar employees is producing enough income that you don't need to work anymore. Let's talk about the specific threshold where your money really starts working for you in noticeable ways. This is where things get exciting because once you understand the math, you can actually calculate when you'll reach financial independence. The concept is simple. You need to build a portfolio of income-generating assets large enough that the returns cover your living expenses. For most people, this happens somewhere between $500,000 and $2 million in invested assets, depending on their lifestyle and the returns they're generating. Here's how the math works. If you have $500,000 invested in assets that generate an average 8% annual return, that's $40,000 per year in passive income. If your annual expenses are less than $40,000, congratulations, you've achieved financial independence. Your money is now working for you, covering all your costs without you needing to trade time for money. But here's what makes this even more powerful. That $40,000 isn't just income you can spend. If you reinvest even a portion of it, your portfolio continues growing, which means your passive income continues increasing. It's a self-reinforcing cycle that accelerates over time. Now, I know what you're thinking. Nick, $500,000 sounds like a lot of money. How am I supposed to save that much? And you're right, it is a substantial amount. But here's the beautiful thing about compound growth. You don't need to save all of it yourself. Your money does a significant portion of the work for you. Let me give you an example that will blow your mind. If you invest $500 per month starting at age 25 and earn an average 10% annual return, by age 45 you'll have approximately $380,000. But here's the crazy part. You only contributed $120,000 of your own money. The other $260,000 came from investment returns. Your money literally earned more than twice what you put in. By age 55, that same investment strategy would give you over $1 million, with only $180,000 coming from your contributions. The remaining $820,000 is pure investment growth. That's your money working for you in the most tangible way possible. This is why starting early is so crucial. The longer your money has to compound, the harder it works on your behalf. Every year you delay is a year of potential growth you're giving up. It's like showing up late to work every day and wondering why you're not getting promoted. Your money can't work for you if you never put it to work in the first place. Let's talk about the different vehicles you can use to generate passive income. This is where strategy meets execution, and understanding your options is critical to building a sustainable income stream. First, we have dividend-paying stocks and index funds. These are companies that share their profits with shareholders through regular dividend payments. When you own shares in these companies, you receive cash payments quarterly or annually without having to sell any of your investment. The beauty of dividend investing is that it provides both growth and income. Your shares can appreciate in value over time while also paying you regular cash distributions. It's like owning a rental property that also increases in value. Then we have bonds and fixed income investments. These are essentially loans you make to companies or governments that pay you interest over time. They're generally less volatile than stocks and provide predictable income streams. While the returns are typically lower than stocks, they serve an important role in a balanced portfolio, especially as you get closer to needing to actually live off your passive income. Real estate investment trusts, or REITs, offer another compelling option. These allow you to invest in real estate without the hassle of being a landlord. REITs own and operate income-producing properties like apartment buildings, office complexes, and shopping centers. They're required by law to distribute at least 90% of their taxable income to shareholders, which means they typically offer higher dividend yields than regular stocks. For those with more capital and risk tolerance, actual rental properties can generate substantial passive income. Yes, there's more work involved upfront and occasional maintenance issues, but the income potential is significant. Property that costs $200,000 might generate $1,500 per month in rent. After expenses, you could be looking at $500 to $800 per month in passive income from a single property. The key to successful passive income generation is diversification. You don't want all your eggs in one basket because different income streams perform differently under various economic conditions. When stocks are struggling, real estate might be thriving. When interest rates rise, bonds might suffer, but dividend stocks could benefit. By spreading your investments across multiple income-generating assets, you create a more stable and resilient income stream. Here's something most people don't realize about passive income. The transition from active to passive isn't binary. It's not like you're working full-time one day and living entirely off passive income the next. It's a gradual shift that happens over years or even decades. In the beginning, your passive income might only cover your coffee budget. That's still a win because it's money you're receiving without trading time for it. As your investments grow, maybe it covers your car payment, then your rent, then your groceries. Each milestone represents more freedom and less dependence on active income. This gradual progression is actually a good thing because it allows you to learn and adjust your strategy over time. You'll discover which income streams work best for your situation. You'll learn to reinvest strategically. You'll develop the patience and discipline required to let your money do its job without constantly interfering. The psychological shift that happens during this transition is profound. When you receive your first meaningful passive income payment, something clicks. You realize that money really can work for you. That realization changes everything because suddenly, you're not just saving money to have a bigger number in your account. You're building an income-generating machine that will eventually set you free. Let me share the most important principle for making your money work for you. Consistency beats intensity every single time. It's better to invest a modest amount every single month for 30 years than to make huge contributions sporadically. The reason is simple. Consistent investing allows you to take advantage of dollar-cost averaging, which smooths out market volatility. You buy more shares when prices are low and fewer when prices are high, which optimizes your average purchase price over time. This is also why automation is so critical. When you set up automatic investments that happen without your involvement, you remove emotion from the equation. You're not trying to time the market or waiting for the perfect moment to invest. You're just consistently feeding the machine and letting compound growth do its thing. The wealthy automate their wealth building. The middle class tries to find the perfect moment and ends up missing opportunities. Here's what your passive income journey might look like in practice. Year 1, you're investing consistently but seeing minimal returns. It feels like nothing is happening. Year 5, you're starting to see some meaningful growth but still heavily dependent on active income. Year 10, your passive income is covering some of your monthly expenses. Year 15, you're generating significant passive income that gives you real options. Year 20, your passive income might equal or exceed your active income. You've achieved financial independence. This timeline isn't set in stone. Some people accelerate it by investing more aggressively or generating higher returns. Others take longer because they start later or invest less, but the pattern is consistent. Slow growth in the beginning, accelerating momentum in the middle, and exponential results toward the end. The question you need to ask yourself is simple. Do you want to spend the next 40 years trading time for money? Or do you want to spend the next 10 to 20 years building a system that generates money whether you're working or not? Both paths require effort. One leads to freedom. The other leads to a retirement that might not be as comfortable as you hoped. Your money is waiting to work for you. It's ready to clock in and start generating returns. But it can't do that if it's sitting in a checking account earning nothing. It can't do that if you're spending every dollar you earn. It can only work for you if you give it a job by investing it in income-generating assets. The sooner you start, the sooner your money begins pulling its weight in your financial life. If you found this valuable, subscribe and hit that notification bell because I'll continue sharing strategies to help you build passive income and achieve financial freedom. Until next time, remember that your money is either working for you or you're working for money. Choose wisely.